Good evening, everyone. This is Chris Smith from TheOptionClub.com. Thank you for joining us for this presentation. I have Steve Lentz from Discover Options with me, and Steve agreed to come on and talk to us about using the MACD in combination with a credit spread trading strategy. Steve, if you're ready to go, I'm going to set you up as the presenter, and you should be able to show your screen then.
Excellent, Chris. Thanks so much. Hi, everyone. Just want to thank Chris for having me here. I'm going to hit show my screen. Let's see here. Show my screen. Let's see what happens. Paused. No?
We can already see it.
Oh, you already can?
Yep.
And so you can see that PowerPoint right there.
We can see it.
All right. Okay. And then what do? I hit Hide Control Panel. Then I can just pull that over there. Now, if I hit F5, let's see. Oops. Let's try this. Oh, excellent. Now it fills up the whole screen, right?
Right.
There we go. Excellent. All right. And away we go. All right. Great. Thanks so much. Chris, I want to thank you for having me on. I just love talking about this stuff. I'm with Discover Options. We're a company, kind of an educational arm of OptionView. And OptionView Systems has been around since 1983 with high-end options analytics software. And Discover Options doing, as well as we have mini classes. And I go around the country occasionally and have been kind of all over the world very occasionally, talking about strategies and options analysis and, using high-end analytics to improve trading. Tonight I want to talk about combining spreads with technical analysis. This is kind of a common theme that I like to talk about, although our mentoring program focuses on more non-directional strategies because our mentors, that's kind of their wheelhouse, okay? And we'll certainly help folks tweak their directional approaches, but we really focus on non-directional. But I like to talk about the directional stuff just because it's just a vast array of stuff to talk about, and there's so many ideas. But what I find is that very few folks, educators out there, really like to combine the technical analysis with the option spread trading. And I find that by combining the two, you can come out with just some outstanding statistics and a trading edge. And this is just one approach that we dive into. So let's just go. Let me click here. There we go. You got the disclaimer, and you've seen the stuff to go and get the brochure from the Options Clearing Corporation. That's a real good thing you'll want to read sometime. Before we get into the strategy, I kind of want to give you a broad overview of our philosophy of education and what I hope you would adopt as a trader that is, in the middle of the learning curve, getting better and better. All right? And so we call this the way of the gridiron. I'm a youth football coach. We're right in the middle of the season right now, kind of winding down, but this is kind of near and dear to my heart. It's a passionate hobby of mine, but the two really do bleed over quite a bit. And the reason is because football is a violent contact sport, and over in trading, every day you're in the market, it can be a violent contact sport emotionally, not physically, of course. Okay, but certainly it plays with your emotions, and it can be quite violent, all right, on your psyche. And so we have a four-step process to getting better at trading, and we take it from, an acronym, we take it from the example of football, but learn, practice, scrimmage, play, all right? All right, in football, a football team doesn't just go from the chalk talk to the Monday Night Football. Okay, there's a process. Okay, they first learn. They go and have a chalk talk. Typically, before a team will be able to execute their offense, they first go into a big auditorium, depending on the the level of the team. Okay, and they'll have a chalk talk first. And likewise with traders, typically we'll go to a seminar. We'll watch a webinar like this, something where we're acquiring knowledge, just raw knowledge, and that's it. Okay? Now, a football team doesn't do that and then go and immediately start playing, a real team in front of a crowd. They then go and practice. Okay? But traders, and we get a lot of folks coming to us, they've gone to a seminar, they've learned a new thing, they'll often just skip straight to the play part where they're putting on big trades after they've learned a new deal, a new approach. And I would hope that if if tonight is enlightening to you at all, that you would first go through a few steps here before you just start putting, big lot trades on. Football teams will practice first, and likewise, traders need to practice first. Okay? Now, in the world of options, it's not easy to acquire historical option prices. At OptionView, we do have that. Some other companies have some historical option prices, but in our mentoring, we lead people through this process where we teach you an approach. We give you the technology to actually practice with historical option prices. But however you do it, whether you're just going to paper trade day by day, all right, that's the slowest way, or if you have a database of historical option prices, we want you to practice first after you learn something. Okay, and with us, we've saved historical option prices every 30 minutes of the trading day since January of 2001. So you can go back and walk forward in time and put trades on, and you could put in a year of trading in a couple hours. And so that's pretty good. Now, after a football team practices, they'll then scrimmage each other. Sometimes they'll have an inter-squad scrimmage. Sometimes they'll go scrimmage against another team. If you watch the NFL channel, you'll see the 49ers and the Broncos scrimmaging preseason. Before their exhibition games, they'll have little, they'll scrimmage each other. And sometimes they'll actually go like 7-on-7, 9-on-9, and then 11-on-11. They'll just get the two teams together to scrimmage each other. And likewise, a trader, before you ramp it up for the Monday Night Football, putting on big lot trades, you want to scrimmage small. If you can't make money with one lot, you're not going to make money with 10 or 100. All right? So scrimmage first. Scrimmage the markets first with small lots. Make sure you understand how a strategy works in the context of your broker's platform. Okay? We've had folks come to us. I tell you, one guy came to us and said, look, I'm glad I came to you, but I got to tell you, last week, just before I came to you guys, I went to close out a spread, and I got confused with whether I should buy or sell the spread, and I ended up doubling up my position rather than closing it out. And this particular individual lost $7,000 within just an hour or two because he doubled up his big lot position rather than closed it out. And well, we want you to scrimmage first, understand exactly how to use your broker's platform, and then you start preparing your psyche, of course, for this. In one of my youth football teams years ago, I had a lower level team, and we were playing the travel team of the same age group. It was the veterans on that side, and then I had the rookies. Okay, so and then these kids were like 8 to 11, something like that. Well, so we go to scrimmage these guys, and I'll tell you what, it wasn't but 5 minutes into the scrimmage that these veterans were just lighting my kids up. My kids, we go to the huddle, and I'm looking around, and there's tears. Some of these kids, they just had no idea, that in a real game against an experienced player, it can be very violent, and it was just a shock to them. And that was years ago. Today, I go to the high school games. I see them over there. It's kind of cool to see kids go from that point in life to now where they're good players in high school. It's kind of fun. But then after you scrimmage, it's time to ramp it up. After you're good at your broker's platform, you're confident in the system, you know that it works. Now it's time to ramp up the size for Monday Night Football, a contract level commensurate with your portfolio. So this is our philosophy of education. We have the technology to do it. We've had a lot of success helping lots of students move along and learn good option trading. Now, on to the topic at hand. Let me get a little drink of my half and half. One moment. All right. Half and half, not cream. I'm talking caffeine, half decaf, half real stuff. Okay. Technical analysis. When we talk about price analysis, we have to ask ourselves, what is truly predictive and what is truly coincidental? Okay, moving averages quite often are very lagging or kind of coincidental. Maybe there's patterns within those moving averages that might be predictive, but we are focusing here on we really want something that's predictive. Ideally, you would have a pattern or something that is predictive of the future. Okay, and so it's important that in the world of technical analysis that we try and discern what is predictive and what is just kind of coincidental. And you have to put on your thinking cap and think critically here. Okay, and that's very important when you start it down this road of price analysis. I'll tell you, you can devote several lifetimes to the study of this. Okay, and you got to really kind of start, separating the wheat from the chaff, as they say. Okay, so here's the lineup for tonight. What is the MACD? We're going to talk about what is the MACD. We're going to look at what an ideal option spread would be to exploit these signals. We'll look at a MACD trading plan, and then we're going to look at some testing results real quick, okay? All right, what is the MACD? MACD, Moving Average Convergence Divergence. Moving Average Convergence Divergence. This was developed by, I think, Gerald Appel, A-P-P-E-L, back in the 1970s, and it's available in most any charting program that you'll have today. And what I'm using here is Metastock. That's my charting program of choice because I can program signals, my own indicators and everything. I think it's a wonderful tool. And the language is pretty easy, kind of an Excel language type, Excel spreadsheet language. If you're good at Excel, then you can easily learn this language. It's far easier than some of the more sophisticated trading systems software programs out there, but this is just what I've started with about 12 years ago and have really liked ever since. Here we have an example of the S&P coming down, and at this point in life, if you're sitting here looking at this, it would be nice to have maybe an indicator giving you a prediction of the future, because that's what happened. And if I told you that there was a really good prediction of the future, I think that might be of some worth to you, to know that there was an indicator which told you at this moment in time the market bottom is most probably very soon coming upon us. And that's what we're going to look at here. Now, here's what you do to get an MACD. Number one, you take a 12-day exponential moving average, and then you take a 26-day exponential moving average. These numbers are kind of the default numbers within the world of the MACD. Okay, now some programs give you the ability to change these numbers around, and it's called a price oscillator. Okay, but if you were to just bring in an MACD, it's by default 12 and 26. That's what they're talking about typically. All right, now what we do then is we graph the difference between the 12-day and the 26. Okay, so if I were to take my little felt tip pen, and what you can kind of see clearly here is that when the 12, if we go over here, when the 12 rises above the 26, we can see down here that the line crosses above the 0. So when it crosses above, that's corresponding to where the 12-day moving average crosses above the 26. Likewise, right here, when it crosses below, it crosses below the 0 right there. Okay, and so this is the MAC. This is the line here. Now, what we do after that is we take a trigger line. Let me see, what's my next screen? Okay, this is a 9-day moving average, exponential moving average of the red line. Okay, so typically a MACD would be kind of considered 12, 26 with a 9-day trigger line, exponential, and these are all three exponential moving averages. Okay, some programs will give you the ability to change these three numbers around, and that's great. And and some educators out there have come up with their little proprietary, family recipe, the secret recipe of these numbers. But by standard default numbers, the MACD is 12, 26, 9. All right. Now what do I do? Okay. So let's take this. Now, so we have the MACD now is graphed underneath the actual price chart. Okay. And let's scroll down. So what signals are generated from this? Okay, there's two types of signals generated from the MACD. First, when the MACD crosses the signal line like I just pointed out. Okay, like I just pointed out, when the MACD itself crosses that 9-day signal line here, 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 these are signals. Not when it crosses the 0 line, when the red line crosses the 0. No, that's not what we're talking about here, okay? We're talking about when it crosses the signal line, when the line crosses over that 9-period line there, okay? That's the first type of signal. Now, you can get whipsawed doing that, as I think you can kind of eyeball here. That's not the best signal to necessarily take. All right, usually when you run a system test like that, it doesn't work out too well in the long run. You get whipsawed a lot. But the second type of approach is what we're going to look at, and that is the divergences. When the MACD diverges from price, this can be predictive. And this is what's nice. That's what I just showed you here. This is right here is kind of what we saw earlier. Do you see how price made a new low over here? Okay, and the MACD did not make a new low. So when price made a new low, the MACD did not, and we had divergence on that swing. So the market came down, went up, came down again. The MACD went down, came up, and it didn't come down and make a new low. That's a divergence. At that point, all right, the indicator is saying to us, okay, now it's a derivative of price, but this derivative of price is showing us visually, basically, that the momentum on the downside in this case is now slowing up. This divergence is a way of telling us that the momentum on the downside is slowing, and it's running out of steam on the downside, and it's likely to turn around sooner than later. Okay, it may turn around, it may take a little more time, but certainly the probabilities is that it's sooner than later. Okay, and in this case, it happened right away. All right, so divergences, that's kind of the signal that we're looking for. Now, how can we exploit divergences in the MACD from price? Okay, now here's the premise that we're going to begin with. Then we kind of back into why credit spreads are nice. All right, but here's the idea. We're going to sell out of the money option premium at strike prices likely to expire worthless. All right, now under promising circumstances, we're going to sell premium 1 standard deviation or more out of the money. 1 standard deviation or more out of the money, and then we're going to challenge the market to reverse course and travel more than a standard deviation in the opposite direction. See what we're doing? All right, so let me back up. Let me just show you here, kind of just the premise behind all this. Let me get rid of this. All right. Here we have price going down. Price is going down, and we have divergence. At this point, we would say, you know what, Mr. Market, we don't think that you're going to continue on the downside a full standard deviation. We're going to go down and we're going to sell premium, down 760, 750, something like that, okay, and challenge the market to go down that far. We don't think you're going to do it. All right, and so that's the premise here. Okay, now, when we start going down this road, we need to talk about probabilities. All right, probabilities, and then we're going to kind of back into the credit spread idea. So in option view, we have this probability calculator. Now, if for those of you that do not have option view, we have a free version of this at discoveroptions.com. Just www.discoveroptions.com. You can sign up for a free account there and have access to our probability calculator that looks very much like this. Okay, now, and it's laid out in the same format. To my knowledge, it is the only free Monte Carlo-based probability calculator available on the internet. All right, so you may want to check that out. But here's what we do. Excuse me, up here. What we do up at the top is we fill in the current price, the volatility that we feel is going to take place in the future. We're going to predict out days ahead. In this case, we're just looking at 30 days ahead, and then the future date, of course, it just fills that in automatically. When you fill in this data, it then goes and then assigns the standard deviation borders. the borders of the first standard deviation, second and third standard deviation. Now, the first standard deviation is by definition about a 68% chance. In other words, in 30 days, the possible price outcomes, about 68% of the possible price outcomes occur within that first standard deviation. Okay? Now, look at this. And this is the important part. Okay, randomly, okay, if you look here, this is the part where the Monte Carlo comes in here, the probability of one of these borders ever getting touched. Okay, what is the probability of these borders of the first standard deviation ever being touched? Okay, we're not talking about finishing, we're talking about ever being touched between now and 30 days out. And roughly, you could see here, it's pretty much about 1 in 4. Okay, so one time in 4, all right, price is going to go up and touch, okay, either the standard deviation border on the upside, 1 in 4, it'll hit the downside border, and about 2 times in 4, it won't hit either of the borders. It'll just stay in the middle there. Okay, now, that's important because, okay, we now have to take that statistic and kind of back into the notion of selling premium outside. If we're going to, by trading with the trend, when it's most likely to end, okay, about to end, a little O right there, sorry about that. We're going to try and improve on the 1 in 4 statistic. So here's the idea, okay, if we're, okay, here, let's see, first target is low, second one is high. Okay, probability of ever touching the highest target, okay, if we were to sell premium at 1,200 in this particular instance, okay, 1 time in 4 approximately, it would go up and hit that. If I come up with an approach, all right, that's going to, sell premium a standard deviation away, we need the winning percentage to be greater than 75%. Okay, randomly, we know we're going to win 3 times out of 4, just randomly. So if we're going to now combine technical analysis with all this, we need to have a winning percentage better than 75%. If we don't, we know we have no edge. Our technical analysis approach isn't, it's not giving us an edge at all, right? Okay, so which strategy allows us to apply this philosophy? And I think it's obvious that we're going to do credit spreads here, okay? Credit spreads. Now, before we get to the system, the trading plan, so to speak, we're going to talk about just what makes credit spreads so special. And for those of you new to option spread trading, this is one of the easiest spreads to understand and apply and to trade. All right, so here is a picture of an option view matrix, and we're looking at just the puts. Let me just explain kind of what we're looking at here. Quite often, let me just kind of go back, quite often in your broker platform, I'm sure you've noticed that your broker platform typically has options laid out in one big long column with calls on the left, puts on the right, and then the front month is way up at the top, second month underneath that, third month all the way down, and then the leaps are on the bottom. All right, that's a typical layout of an option chain, right? Okay, now that's fine, because in a lot of these brokerage firms, these options, brokerage firms were started by folks that came out of the option pits at the exchanges. And if you're a market maker, laying out the options like that, that makes sense, because you can then look at conversions and reversals and market maker type relationships very easily that way. Now, but for an off-the-floor trader like us, okay, that approach just doesn't quite, we don't feel that that's a good way to lay out the options. We feel that it's best to have the strikes, the calls and the puts separated, have the puts all together, separate from the calls, and then read across the screen we have the months laid out like this. Okay? So we're looking at all the puts, the same strike puts, and then in this way we're able to now view horizontal volatility relationships far easier than having to look straight up and down the screen like that. And so OptionView was developed by an off-the-floor trader, Len Yates, when he thought of this back in the early 80s, and it's just been a great way to kind of create a, I guess you could call it a chessboard of options that you can wrap your brain around and kind of look at spreads and really start playing the game. It's pretty cool. Now what we've done is we've laid this out with the at-the-money put here. The in-the-money puts are above. The out-of-the-money puts are below. Okay? Now, here we have a credit spread. We can see that it's in November. This is back from September 22nd. And you can see that it's a 50-point spread. We're proposing a little one lot here. And if you look at the price differential, you'll see that it's $11.50 and $6.50. That's a $5 difference. Okay, now that's going to be a credit because we're selling the 1025s for $11.50 and then buying the 975s for $6.50. That's a net credit of $5. We're selling the spread for $5, hoping that in time we'll be able to buy it back for less. So we're always trying to sell a credit spread for high, buy it back for low. All right, now there's a time benefit to credit spreads and a directional benefit to credit spreads. Let's look at the time benefit first. Notice that the same 50-point spread out in December, more time, almost 90 days out, okay? Basically, it's the next month out. That same spread sells for $6.70. Okay? 1 month later in November, where we have our little proposed spread, it's at $5. Now look at the October one. 1 month later, it's at $1.75. So what this is showing you is that if all things stayed the same except time, if price, volatility, everything just kind of froze and only time went by, our spread would automatically pretty well go from $5 down to $1.75 in the course of roughly, 35 days or so. Okay, that's just the time benefit. Time itself is benefiting us when we do this because we're selling premium and letting it decay. Okay, now let's look at the directional benefit. Here's the directional benefit. We can see that our spread is $5. Another 50-point spread, okay, further out of the money, is at $3.60. So what we're seeing here is theoretically, if today the vol stayed the same and everything, it's just that if the SPX were to go up and this spread were to drift 25 points further out of the money, our spread would go from $5 down to $3.60. $5 down to $3.60 there. And that's the directional benefit. So we have both time and direction working in our favor there. Okay, and that's a great combination. Visually, if we now in this, some of you I'm sure are very, very familiar with these risk graphs. I'll explain it very quickly. OptionView does a fantastic job of giving you very, very accurate risk graphs like this. And but if you're just beginning in options, let me just do this for you real quick. This is a grid. The x-axis is the price of the SPX. If the SPX goes up, we move to the right. If the SPX goes down, we move to the left. Our dollar amount of our profit is on the y-axis. The y-axis is the dollar amount of our profit. Anything above the break-even line is gain. Anything below it is loss. Okay? And what you're seeing here then are three lines. This dotted line here is today's risk line, so that if today, okay, the market went up, we could see that if today the market went up to 1165, looks like we would make roughly, about $250, something like that. Okay, Now, the expiration line, at expiration, we're at the solid blue line. We could see at expiration, we would make our entire credit across the vast spread of prices all the way down to that strike in which we sold it. After that, we start losing money there. Okay, so as long as price stays above our short strike, presented here. Okay, so that's what a credit spread would look like. Now, here's the trading plan. Here's the trading plan. Bullish trades. Okay, after divergence occurs, all right, where we're looking for those swings, where a swing doesn't go down as far as where you have divergence on a price swing, diverging from MACD here. Okay, once you have divergence, we're going to look for an up close. And on the first up close after divergence, we're going to sell a put credit spread, a standard deviation or more out of the money. Okay, so now in this example, we had divergence occur, price came down, and on that first up close right there, you see that little bar right there? On that up close, that's when we sell a premium, a standard deviation out of the money. Now what we're doing is we're going out to the first month with more than 21 days. 21 days, that's where we're going. So if the front month has 18 days, we're going to the second month of trading. If the front month has 22 or more days, then we're going in that front month. So that's kind of the cutoff, what we're using. We go there and we go a standard deviation away, and we sell premium at that point, a standard deviation away. In this case, it was at 725 strike. Okay? And then we did a 50-point spread in this case. We did a 50-point spread. You can see clearly price immediately reversed and went up. This spread clearly would have expired worthless, and we would have kept the whole credit. Okay? Now, on a bearish trade, kind of the opposite. Here we just wait for a down close. Once we have divergence, and on the first down close, we sell a call credit spread, a standard deviation away. So when we had divergence, we waited for that first down close, and boom, we sold a premium right there. Okay? And then clearly, even though price kind of even went up a little bit, okay, it didn't go up and hit that strike. All right, so what's the beauty here is that, you know, we don't really need price to go down to make money. All we need for it to do is not to continue up to that full standard deviation, and that's the beauty of this thing. You don't have to have price go down. You just have to simply not be so wrong. Here it just channeled around in a fairly decent channel here. It's still 100% winner. You made the full amount. That part's pretty cool about this, all right? Now, risk management. How do we get out of this trade? All right, there's two approaches. If it hits the short strike, we're out. Okay, that's number one. Otherwise, we allow it to expire worthless. Real simple. Now, some of you are very sophisticated option traders. I know that you've been watching these presentations, and I know other speakers have come in and talked about pretty advanced things. And you might look at this and go, gosh, you know, if in this particular case, if I sell this spread, the market blasts off, I'm going to make most of my money right away. And you know what? You can absolutely feel free to throw in a rule that says you're gonna grab once half your yield or once 3/4 of your yield is available, you're gonna close that spread out. That's fine, completely fine. Okay, but for testing purposes, just to see if we have an edge here, just to see if we're going to beat that winning percentage of 75%, we had to take it to expiration. But I understand completely, and I do this myself when I put credit spreads on and I have most of the money available. Bang, I'm going to take, we take it off, right? But we're exploring this to see if we have a statistical edge here. Okay, so if we're challenging it to hit the short strike to travel that standard deviation, or we're going to let it expire worthless. All right, that's what we're looking at here. All right, now I'm going to show you the testing results. Here's the little disclaimer. Basically, bottom line says that past results are not necessarily indicative of future performance. That's the bottom line. So these are hypothetical. I went back to 2001, and I'm using, let's see here. Let's see, when you can kind of see, all right, here's the list, going back to 01, of the trades we put on from 01 to 2010, all the way up through, yeah, there hasn't been a signal occur since July, okay? And what you'll see, and I tried to, list out every one of these. These are 50-point spreads in the SPX, all right? And what you'll notice here, it's wonderful, 4 losses, in all of that time. And I'm labeling out here. The first one, kind of understandable, okay? 9/11. That was the 9/11 where the market obviously gapped and ran, and, we lost a bit of money there. Next, the summer of '02. We talk about 9/11 being a shock to the market, and even, of course, '08 was terrible. Not in this approach, but in other approaches. But I'll tell you what, if you want to, and this is kind of nice, having the database we have of prices, we can go back and shock test any approach, looking at the 9/11 gap. I'll tell you what, the summer of '02 was pretty nasty. So if you think you have a good option trading approach, and you want to shock test it, see how it survived 9/11, 2008, go to the summer of '02. Take a look at a price chart on the SPX. Summer '02 was very, very challenging for option premium sellers. So that's an area, for us anyway. I like to go back, and our database is called Back Trader. Okay, it's kind of our our delayed approach to options pricing. If you want data in option view, you can get Back Trader, and that acts as kind of a delayed quote feed for you. But it also has historical prices going back, and you can go back to '02 and then and shock test your approach there. Oh, then there's 2 other losses in '03 and then in '06. You can see clearly there. Okay, so not too bad when you summarize it all. Okay, I'm using $1 option commissions, $1 per contract. I was trading just 1 lot spreads there, 50-point spreads using 1 lots. 34 total trades, 30 were winners, that's 88%. That's the key statistic. Remember, we were trying to beat 75. And so 88 is higher than 75, so we see that there is a trading edge there. Okay, not too bad. 4 losing trades. And here's another key statistic. Okay, our average winning trade was almost $300. Our average losing trade was almost $1,300. Okay, and some of the losses occurred in the some of these losses occurred in the calls where you just didn't get that much premium to begin with, yet you lost quite a bit. Okay, so you can kind of clearly see when you do lose on this, you can lose quite a bit more than what you're trying to make. Okay, and that is kind of par for the course for premium selling approaches. The idea is to try and lose as few times as you can, and I think this premise is about as good as you're going to get when it comes to challenging the market to do something. So I think we clearly have an edge here. You can kind of see over that time it definitely made a net profit. At one point we had 13 consecutive winners. All right, and you can kind of see the other statistics. All in all, it has a trading edge. Whenever you see MACD diverging from price, all right, if you wanted to put on an option trade, high probability, this is one you should consider doing. Just a 1 standard D credit spread, challenging the market to hit the short strike. Okay, it's something that we've been watching for 3-4 years now. I taught this a number of places, and then people kind of, they report to me, this is a counter trend approach. Okay, now, and you gotta have to have the gut for it. I mean, you're definitely trading against the trend. You're challenging the market to continue a trend that's been going on for a while. That is not everybody's cup of tea. All right, and I understand. We also teach a trading with the trend approach using the DMI, but this is a counter trend, and so you kind of have to evaluate if it's in your personality. But you know what? Go back to the learn, practice, scrimmage, play, the way of the gridiron, and then you'll kind of quickly see if this is going to be part of your trading approach. it would be a great approach to blend in with your trend following stuff, okay, especially if you mix it in with other markets and everything. Okay, before I take your questions, if you have any, want to point out that we have a special offer going on at discoveroptions.com. We have some self-study courses. If you were to call and talk to the folks there at Discover Options, talk to Tom, James, or Karen, they'll tell you about we'll give you $100 off any self-study course that you want to sign up for. And what you do is you just go to our website, and on the far right side, it says Discover Options classes. You can sign up and or call in and just mention this broadcast, and we'll be glad to accommodate you there and tell you about those and about our mentoring pro. Okay, now, are there any questions? Let me see. Let me click to open up the question panel, and let me see. And let me see how I can. I'm just going to try and. Oh, good. Whew, look at all these. All right, wow. All right, let's see. Okay, we're comparing BackTrader view with Think data from Thinkorswim. Okay, I'm not too familiar with Thinkorswim's ThinkBack. I understand they changed it a little bit. I'll just tell you what we have. What we do is BackTrader has saved option prices. We do a snapshot picture capture, basically, of all the option prices, stocks, futures, indices, everything across the board. We capture those prices every 30 minutes of the trading day. Okay, so that when you bring up BackTrader and Option View, the whole thing becomes a time machine. You can go back in time. You'll see what the option prices were at that particular half-hour segment of any trading day. And you can actually then create a dummy account, execute a trade, and then walk forward in time, either half-hour by half-hour, day by day, whatever you want to do, and you can kind of just see how your position would have done. All right, it's a really cool thing if you've come up with an approach that you want to test. I've spent several days, manned days, if not weeks or months, in BackTrader testing out various systems, including the ones we teach in mentoring. So hopefully that'll have addressed some of these questions. Okay, another question here on histogram, MACD histogram. I just look at the MACD. I don't look at the histogram that much. A derivative of a derivative, you start getting too far removed from price, and it gets kind of, out there a little bit. I like to keep things as close to price as we can. Just take the first derivative, if possible, and go with that. Okay, that's kind of my opinion on that. It's I find it a lot easier. I've got to, the whole thing with the VIX and all that being if you think about it, the VIX is a derivative of a derivative. It starts to get several times removed when you start having options on the VIX futures. It gets crazy. So let's try and keep. Trading's hard enough when you don't have too many, get clearly out there. Okay, let me keep going here. Okay, I don't know. Chris, I see they're asking something about the TOS Analyze page probability calculator. I couldn't answer that question.
Yeah, I don't use the probability calculator that much myself, and the best advice I can give is whether it's the Thinkorswim platform or any other platform. Ask the guys over at Thinkorswim, because it's their software and they're going to give you a better answer than most people will.
Okay. Let's see. I'm just going through these questions. Good question. Mike asks, how many days minimum will pass to verify a divergence? Good question, Mike. I like to just look at the swings. I think you want to have a swing in place. If you just have price make a new high or low and the MACD slid off and isn't quite up there, and you have 1 or 2 days and it's not a full swing, nah, I want to see the market actually have a few days swing, down, then up, then down, where there's a separation, in, a clear one in swings, that might be a little discretionary. I guess if you were to make it, and that's what I did when I did these dates, you know, and that's why I kind of list this out, the results here. Let's see, going back up here, and you can kind of go through these dates, and you might find ones where you kind of, I think you'll find, you know, definite divergence in all these dates. Okay, but you know, what's more important, Mike, is the swing nature. Okay, close half. It appears. Great question from Scott. Okay, my assumption on future volatility. How do we select the future volatility percentage? Great question, and you know, I think we have to kind of, you know, what now? Here's what I did. Let me go back here. Okay. When we do the probability calculation for deviations, okay, I was taking the at-the-money implied volatility, okay, and the at-the-money call and put should be very similar volatility levels, implied volatility levels. Arbitrage will keep those numbers the same. The out-of-the-moneys get different, of course. You have skews. The at-the-money implied volatility is the volatility used to derive your first, second, and third standard deviation borders when you calculate how far out you should go. Okay, so I'm using the at-the-money implied volatility, and I'll typically go to the calls and look at that. But when you're going to determine your standard deviation, I would suggest using the at-the-money implied volatility of the month in which you're selling premium in. Okay, Steve, does this approach work with individual stocks as well as with index products? Bob, I like the indexes because the company risk in stocks can kind of throw a wrench in the spokes. You got announcements, you got earnings, et cetera, et cetera. An index, you remove that, you know, most of that component, and so that's why we favor indexes, you know, for doing this. But feel free, I mean, absolutely, and look at a chart on a stock. It's just, I think in stocks you're going to find that where divergence didn't really, you know, play out, the stock, something happened and it kept going, and that company element, you know, makes it not as desirable as an index. How do you find divergence trades from SIA? You know, you know, you could just scroll through price charts, SIA. If you're gonna, what you do is you set up MACD in your price chart, and hopefully you have a system where you can just click, 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 and you just run through a bunch of charts, eyeballing for certain things. Okay, now in Metastock, you can program it to show you when you have divergence. Okay, show me the bar where it made a new 20-day high and the MACD did not make a 20-day high, something like that. And in Metastock, you can program, it's called an expert, and you can program an expert to then have a little arrow appear on the price bar, or the price bar can be colored when that condition is in place. And it's very simple language to express in Metastock. You know, Chris, there's a lot of questions here. How long do we have? I'm looking here. I'm not even halfway. So give me some direction here. Did you see ones I should definitely answer, or how are we looking on time and all that?
Well, we usually schedule these for about an hour, and so we got about 10 minutes.
Okay.
And what I can do to kind of help you out a little bit is maybe I'll start picking out some of the questions, because what I have found is that there's a fair amount of duplication that occurs, and then there are also some kind of outlier questions that may not be of interest to the group at large. A couple people had asked about whether or not you would trade both sides of the market, both the calls and the puts, and essentially roll this into an iron condor.
Oh, yeah. No, this is a purely directional, a counter trend directional play. Now, we do have another approach we use with the DMI that's with the trend, and then that does roll into condors. But this is a counter one, and so you know, in the context of a MACD divergence, no. But if we do have an approach with the DMI directional movement indicator, that's another that's a Wells-Wilder one tool where we certainly do that. Yes.
I have a few questions here that essentially come down to whether there are any pre-built experts for identifying divergence or MACD divergence on the on Metastock.
In Metastock, they do not have them built in. Okay, you have to buy. When you buy Metastock, you have to code that yourself. That's something I've done for both MACD and RSI, and it's fairly simple to do. Once you learn the language, you just simply create a condition. But the tricky part is you have to determine the number of days. Where price has made a new 10-day high, and MACD has not made a 10-day high. That's the condition right there, and you can easily code that in and have the arrows and all appear there. It's just that you're going to have to tweak and play around with the number of days, 10-day high, 5-day high, etc. And you'll kind of you'll see some divergences appear and others do not. Then.
Is there a better way, or no, I'm sorry, is it better to create the strategy with ETFs versus stocks?
Well, ETFs are certainly going to be better than the stocks because you're eliminating some of that company risk. Okay, now, but not all of it, because ETFs, of course, are you're dealing with a sector, but spiders is certainly going to be the same like the SPX here, and you could certainly do it that way. But again, with stocks, you got that company element there. Now, what you'll find out, you're going to find though that with stocks you have the company risk, but okay, the implied volatilities are typically going to be higher. Here you see 20, 30% with stocks. You're going to get 30 and 40%, and so you're going to have higher yields on the trades that you make money with. But then again, you're taking the higher risk with the company risk that you have there. So again, you have to kind of settle in on your cup of tea here. And we have students that are much more comfortable in stocks than indices, and they trade all our strategies in stocks because that's their wheelhouse. And further, they enjoy it. It's kind of like in football. Do you enjoy playing in space as a linebacker or being on the line? When you're not in space, so you kind of, if it's your wheelhouse and you enjoy stocks and reading about all that stuff, then absolutely you can apply the strategy in stocks. But you should be one that is definitely familiar and comfortable dealing with the company risk there.
Here's a good question, and I'm going to kind of paraphrase a little bit. Basically, is there a minimum return that you're looking for on the credit spread, or a minimum credit that you're going to accept?
Well, yeah, in the testing we did here, I was just seeing if we were going to beat the 75% winning percentage, which we did have. Now, let me go back and find that chart. Where is it? All right. Here you can see, okay, some of these trades didn't produce very good winners. The yields were much, much lower. All right, you see, let me see here. Oh, there we go. Am I here? There we go. I mean, look at this, $148, $178. Those aren't very much. Remember, you're putting up $5,000. It's a 50-point spread, $5,000 minus the credit. Okay, so 118. That wasn't much of a credit there on $5,000. Now the thing is that some of these are longer than others, and remember, we're taking the first month with over 21 days. All right, some trades are going to be longer term than others. Some are going to be certainly much shorter. Okay, I'm just looking here. I mean, this is less than a month. This is about a month. Okay, this is let's just look at a few others here. Some of these are, I mean, look at this one. This one is well over a month. Okay, and so, there's, in my own personal trading, and I think in yours, I think in all of our trading, we would look at this and go, you know what? Do I want to make $118, and if it doesn't go against me, lose an average of $1,200? Maybe not. maybe we would not take that trade. But we know we're dealing with an approach that has almost a 90% winning percentage. That might be a trade we don't take. Okay? So, to that point, and it's a good one, there's a difference between doing the testing, seeking just a baseline level of statistics, and then actually in your own trading, I'm not going to take that trade, quite honestly, to be honest, which, we try and be. But you know what? Here's one that we would take. That's a good chunk there. Okay? And so is there a minimum amount? That's going to come to you and what kind of an options trader you are, and how well it blends in with your other strategies as well.
Okay, I think we've covered most of the questions. We have a few more about rolling the opposite vertical into an iron condor and whether that would be advisable or not. And the one other question I have here that David just threw up, I saw it earlier, is are you only using the daily charts for this?
Yes. Yeah, this is all on daily charts. Yep. I'm trying to think if there's several questions on that. Let me just let my brain go here. Here you have the trend. I mean, if you were to do this, let's just think this through. I mean, here the market's going up. You have divergence. Okay? You have divergence go on. You're suspecting that the market's finishing up. Okay? Let me think here. And it's finishing up. You're going to sell premium a standard deviation out. Okay? What is going to trigger you to then go and sell premium down a standard deviation on the other side? Okay? Could it be that that you take this trade and then you put something on down here after you have maybe a buy signal of some kind? Okay? Here you're not getting a buy signal. You have triple divergence going on here if you look closely. Okay? So I would say that would be fine so long as you had a with the trend signal. Okay? So you have a counter trend signal in this divergence. What is going on that's telling you to go long, go the other way, such that you're going to challenge the market to go down a standard deviation, that it's unlikely to go down a standard deviation? Maybe if price breaks out to the upside and makes a 10-day high after it's diverged a bit, then go ahead. You would need to have some kind of a justification, so that maybe something else with a separate level of edge that more than 75% of the time this happens and it doesn't go down and hit the other side. I hope that makes sense. I would be looking for something to counter it the other way.
The experience I've had doing that is that it sounds like a good idea on paper, because you're going essentially increasing the credit without increasing your margin, and it feels like a good thing to do. But the problem I've seen more often than not is that you expect the market to maybe slow down, so you sell the opposite side spread, and it just keeps on going, and it covers the ground on that standard deviation. And some people can trade that sort of thing effectively. A lot of people will put the spread on and then just kind of get clobbered by the market. So I think if you're going to do it, what you just showed us tonight is simple and straightforward. And if you're going to try to trade the opposite side at the same time, you're going to be adding a level of complexity that the average trader, I don't think, is prepared to deal with. And I think there are people who are able to deal with it. I think there's others that keeping it simple is a good thing.
I see a question here. Juna asked about the huge spreads between bid and asks on the SPX, and I wanted to answer this. Remember, what we're doing here shoot, where's the thing? We're looking, Juna, at 25-point strikes. Okay, this is something that Frank Fahey, one of our mentors, presented to our class just recently in one of our sessions. If you were to dial up a list of the volume and open interest levels in the S&P strikes, all right, the 25-point spreads have far better liquidity, and the spreads are far tighter. Execution is far better at the 25-point strikes than at anything else. Now, and that's what we really instruct our students to look at. If you're going to trade the SPX, and Frank manages money in the SPX, okay, and he knows. I mean, he's trading his own account and the accounts of others in the SPX using the same strategies we teach, okay, and he deals exclusively with 25-point strikes. Your executions are very good at those strikes. Now, the horror stories you hear in the SPX, those are typically going to be at strikes other than the 25-point strikes. I want to make, Chris, I want to make that point there because it's a good point that Juna brings up.
Yeah. Also, with the bid-ask spread, the thing to remember about the bid-ask spread on the SPX is the bid and the ask are, it's like going to the car lot, and they got the sticker on the window, and this is what we want for the car, and that's the market maker saying this is what I want for the option. That's why you use a limit order when you put the order in, and you're going to try to sell it at or near the mark price, which is the mid price between the bid and the ask. And if you take a hard look at this and you compare the SPX to the Spider, both of which track the S&P 500, the SPX is a bigger, much bigger contract. It's 10 times the size of the Spider. And if you look at how much slippage you're giving up on the Spider, which is probably about a penny, maybe a couple cents, and you compare that to what you can get filled at on the SPX, and you equalize it for size, it's about the same. You're really not giving up that much on the SPX. It's a pretty liquid contract.
On a 2-cent spread, yeah, I think that penny spread is tight, though.
It is.
And that's what's nice about that Spider. I like Spiders.
But then you also factor in your commission costs. If you're paying, let's say, $1 a contract, that's a $10 commission on each leg to do the same size on the SPX.
Right. Yeah. No, you got to definitely factor that in. Let's see. Yep. 10 times SPY. Interesting. Okay. I didn't see any others. All right. Well,
Steve,
anything else we should talk about, or?
Oh, we'll be here all night if we keep going. That's the problem. Once we get off track, it's a slippery slope.
Right.
I think it's a good time to wrap it up, Steve. Thank you very much for taking some time out of your evening.
Well, I've enjoyed this. I just love talking about this stuff. It's awesome, folks. Thanks for having me. I really appreciate it.
Yeah, we're glad to have you. You're welcome back anytime.
All right, Chris. Take care.
All right. Good night.
All right. Good night.